Welcome again, everybody, to our bi-weekly Learn and Grow session on letting this person in. And today we have a very special guest and a good friend, Shahryar Khan, with us. A little bit about Shahryar. He's a co-sponsor of 1,200 units since 2022 and has purchased over 200 plus residential properties in Houston area since 2027. He's retired from Royal Dutch Shell after 15 years of having numerous leadership roles in engineering, corporate planning, portfolio strategy, and business unit finance manager. And today he's with us to share his insight on developing a team and skill set to win deals. So welcome, Shahryar, once again. I'm super excited that you're with us today, and we'll love to hear your insight. Stage is all yours.
Thank you so much. I really appreciate you inviting us on behalf of Massive Capital and share some of our journey with you. So my plan was to share a little bit about us and how we think and how we went about it, especially last year and a half, and also the life of Massive so far. That way, you get to see how we operate, how we think, and how we like that whole team mindset of it, right? So again, thank you. So Massive Capital is our company, and we started January last year. The teams came together, but we bought our asset for the first time was in April last year. So that's that. And our Massive team, as of about a month ago, this is our team looks like. On the left-hand side, we have three partners, Sanjay, me, and Mike. All three of us are recovering engineers. Mike and Sanjay and I follow a very similar path. I'm electrical, he's mechanical. We did our engineering, work for the engineering firms. I used to work at Shell. Then both of us went to MBA. I went to Rice. Sanjay went to Booth. Then he went to finance, worked at Barclays, Capital One in UK, ran a pretty good operations. Then he came back to the US and went to full-time multifamily in 2016. So he was a right-hand man for one of the large operators out of Dallas till about 3 years ago. Then he took a year off and he shut everything down because of family reason. Then when he came back online to the multifamily space, we were introduced and one thing led to another one. We became friends really quick. And our first asset that we bought in April was a $16 million asset. Same with Mike, subsurface engineer. I think he worked outside the US as an expat more than he lived in the US. He used to work for ConocoPhillips. He retired about 3 years ago. And he went to multifamily pretty strong about same time, 2.5 years ago. So someone told us that, hey, meet Mike. He'll be a great person to know. Then we went in and we started the conversation and we really hit it off. Within 2 days, I think Mike, Sanjay put together the proposal for the Pasadena property that we bought. And here we go. We bought our first asset. So the story behind the story was us four, when we met, we were asking each other, what is the purpose of coming into multifamily? And then what is the exit, or what's the definition of good looks like? We all come from the corporate. And we said, we all played solo, right? And I bought a couple of hundred properties in the last 5 years in Houston. Sanjay has, 50 to 70 houses. He left with half of them. Mike did the same thing. He bought around 1,000, 1,500 units before he met us. We asked the question, we can play and individually, or we can do something else. And if we partner, what is the purpose of the partnership? So it was one thing led to another. Then we said, fine. If you come together, then we'll build a company that can take $500 million worth of assets in less than 5 years. And that was the thing. So we went to the whole corporate mindset that we're not coming here to build me or my legacy. We're coming here to build a team. And that team should have a leadership team who can run $500 million worth of assets. And that team has to be able to say, I have been there, done that. May not be in the multifamily domain, outside of it. So we went into that mode. And we are proud to say all of our relationship has been built on a skill set, not on relationship first. Relationship came after, but skill first, relationship after. So between Sanjay, he ran, I think the largest portfolio he ran, it's around $2 billion. The largest portfolio that I ran as a finance manager, it's right around 23 billion. And Mike is the similar. He ran the expat engineering. It's about 7-ish billion. So we kind of sort of have seen that. Then we decided to build the team. We spent almost a year to build the team as of what you see on the screen. And everybody here that we reached out to them. I don't think anybody came to us. So we are proactive about going in and build the team. You guys know Trevor, Jasmine, Maria, Candice, Aksa, Brad, everybody. We reached out to them. Our whole philosophy was that playing by yourself is great, but playing together is much more fun because we are building on top of our shoulders. And everybody here, they have a specialty, they have a skill set that others don't. What Trevor brings to the table, I'm comfortable to say I didn't have it. And what I bring to the table, that's going to complement Trevor, right? That's how we're going to build the team. And together we go further out. So that was that. And we've been blessed with all of our people, and all of our team members has been with us so far. So knock, knock, nobody branched out. So I'd say our team stays. One of our tagline is stay together, stick out. Once you stick together, mistakes will happen, but if you can talk through it, we'll survive. And then what do we do in terms of a transaction perspective? We play in all verticals. One of the things that we have done is that, okay, as we build the team, we need to buy assets. And for us, it's a probabilistic view of it. That means if I want to buy assets, I need to have a higher likelihood of winning a deal. That means that if I decide to do one particular strategy in one particular city, in one particular price bracket, my likelihood of winning goes very low. So we kind of step back and say, hey, US is our marketplace. Are we going to play all categories? Are we going to go all in? So we did a lot of back-end data analysis. We have our internal proprietary data set that we do. A version of that we use to build my residential company, which we helped us buy one property every 4 days. We used a version of it, looked at the whole US, and then we reached out to about 11 to 12 large senior multifamily players that our requirement is that we believe you are senior if you have had at least $300 million worth of asset for at least 5 years. Then we'll call you senior and we'll go reach out to you. So we did some homeworks and everything else. So we brought it and said, hey, we'll buy land, we'll do construction, and we'll do operations. And we're comfortable to say, hey, what we don't know, what we do know. Construction and the land development has not been our forte. So we partner with the partners. Operations, we have it. Renovation, we got it. So we lead the way. That has been our strategy, that we lead wherever we know and we partner where we don't know, but together we stay and all. But make sure that we know the stuff that we're going to do as a team. So now we buy land for new development, and we also do value add on the renovation, and also we buy existing assets if the pricing makes sense. So we bought, me, Sanjay, and Mike, before Massive, put together about 400 properties, land, warehouse, retail, and multifamily. Things we never bought, it was student housing and hotel. We still don't buy them today unless our partner tells us. So that's that. From the asset perspective, and for the location perspective, we went in multiple locations at the same time because the way we look at the market is that US is our marketplace. We are project managers and we are money managers. So our job is to identify the locations where we have a better likelihood of getting the return. To do that, we need to know each of the location that has been there, done that, like those are proven markets. And to make sure that we understand those are proven markets, we need to understand the characteristics of this state and the city, and then we kind of build it. So example, I'll give you Texas and Colorado and Carolinas. Houston is different than Dallas. San Antonio is different than Dallas and Houston. Austin is just the island in the Texas. Austin is very similar to Colorado, Denver market. And Dallas market is very similar to Carolina market. So when we look at it, we say, okay, what's our odds of winning a deal? Then we say we're going to play in all those markets as we kind of go. One of the reasons we were able to go together because we have operating partners in the local locations there. So put together as a team, we always owned assets. So early on, when we started the partnership, we have definition, right? So our definition of local is that we have owned an asset for 24 months in the local area. So we have been through tax cycles, insurance cycles twice. We have done kind of rehab so people know us and we know them. That's the philosophy. So we built local sub teams in Carolinas and Georgia and then Colorado market so that collectively as a team, we have the local footprint. So whenever we bought assets in all of those markets, as a team, we owned the asset for at least 24 months. So we know it. So we went in all those markets. And then, we entered the year last year with $106 million, all the places. And it was a lot of work on us. The reason being is that understanding those sub-markets, it's extremely, a heavy load of work, and we would not be able to do it unless we had the team. So when we brought the team, we built on finance. So Bhaskar was there with me from the very beginning, and Ramesh was there with me from the very beginning. Bhaskar comes from Shell. He's in India. I worked with him at Shell for 4 years on the FP&A side. Then he left, went to Dubai as an expat. We brought him back as an expat. He lives in India, but he runs our finance shop. So we went in building a skill set. So me and Bhaskar used to underwrite, and give or take 30 deals a week. Then we have our own database now that we can see how many deals have underwritten, all this other stuff so we can make progress. So that's how we went in those markets. And, still our philosophy has been the same, that multiple markets, multiple asset classes, lots of learning, and the learning gets built on top of the team. So that was our first round. And then back for the your market down cycle. I'm a macro guy, Sanjay is a macro guy, and we are a lot more academic, I would say. So what we say is that everything has a rhythm to it. I've been through 3 down cycles for oil and gas. I was fortunate enough to work with the CFO of Shell, Tadesh Nate, for 4 years in the US. When 2013, the oil and gas happened, we took a upside down business. It was a $21 billion business. It was valued at $13 billion, then took it to about 24 in 3.5 years. That was my first time I've seen how to take an organization during the down cycle. And then we have been through 2 more. So what we do know when this cycle happens, there are 3 things has to be true. Your balance sheet will get you through the down cycle because lending will go down, and the team will have the borrowing capacity, they'll survive. Then the liquidity will get you ahead in the game because, interest rate is high or whatever it is, price is low, margin is tight, bank's not going to give you loans, the balance sheet's got to be there. And if you have some sort of liquidity, then you can do a transaction. And third one is the team. You go after the team. That you build a solid team during a down cycle, because that's the only time when both parties will be willing to talk to each other because both parties in a rough spot, right? So that's why you'll see that on the large organization, us, when that price goes down, we are heavy on M&A, extremely heavy. We bolt on acquisition, margin, partnership, that's what happened. So we took the same strategy, and we saw that coming earlier last year. Not exactly how it played out, but we had a version of coming. So what we have done is, after we bought our Pasadena property, that was a floating debt, and we had rate cap at 6, we stopped buying any debt on a bridge loan. Your philosophy is, we don't know how that's going to play out, but I'm not going to take a risk. We'll buy everything on a recourse debt. So we are one of the handful of syndicating team. We're comfortable with the recourse debt. So after our portfolio, Fate, Denver, Fate Land, everything was those 3 assets up until September. We bought on a bank full recourse loan. We loved the team. We loved the play. We put our balance sheet on the line. We bought the recourse loan. That played out for us, for wrong assumption, but the intent was right. That played out for us, right? And right now, 100% of our portfolio had a fixed debt. Come September, we saw the rate went up, and we assumed that rate's going to go up a little bit more. And so we flipped. So we said, okay, we'll do a loan assumption. So we bought that McCollum. It was a 4%, less than 3.95% loan assumption for 7 years. We said we'll buy 1 loan assumption just to see what it is. That's a $60 million deal. We bought that as a loan assumption. That loan assumption fixed rate for 7 years, so market could go up and down twice. We'll come back on the other side, and it's playing out well for us. Right after McCollum, we saw the market went up, And then we became bullish much more because recourse loan has a very pressure on your balance sheets and on us. But on a non-recourse loan, it gets better. So up from the Q1 this year till now, all the deals we have bought, except one, is all non-recourse and all market-rated product. As of now, right now, we don't look at any deal that has less than 5% interest rate. And we don't look at any deals that is somebody else's, which is a full recourse. So between those two, we're looking at heavy on a bridge debt. We're looking heavy on a construction, heavy on a, I would say full non-recourse loan, because our assumption is that real estate runs on finance. So we need to be very close to the financing philosophies. That's also because big boys, they know more than the market than we do know. And if they made a choice, I don't know why, but I'm not going to debate it. So I'm going to stay close to the choices. So we follow heavily with the feds and we stay close to the lending capacity. And that's how we take a look at the world. So it's a blend of corporate structure, data analysis, and finance. Then we go about looking at a deal. So for us, it's not the deal. What we buy today, it was different 6 months ago. It is going to be different next, 6 months down the way. But we're going to buy that has a good margin and produce a good result for investors. That was a lot. So I think I can stop here and I can go a little more of some of the assets that we have bought. Then I'll open up for Q&A. This is the asset we closed, Warner Robins in Georgia. It's a very cash flow market. We love it. It's a little more tucked in, but the price point makes sense. It's a C, will be a C, but it cash flows, or we make that location better. We partner with the local operator there. They own about 1,200 units there. So there was a bolt-on acquisition for them. It was less of a learning for us about the local area, and we leveraged the partnership. X-Space, this is our first Class A plus construction in right by Galleria, Houston. We are partnering with the brand called X-Space. This is the second building that we're bringing. This is awesome. It's fully funded. We're closing it next month. This one, we had a 317 units Class A new development in Energy Corridor. It was a fantastic project up until 6 months ago. Interest rate killed the project, so we're out of it. So we're now closing it. It was a huge learning for us. We closed that in Dallas. Again, this is a partner who already owns another 56 units, about 10 minutes down this way. And this was a bolt-on. So based on the learning, and we're doing a new construction in Austin. And this is the McCollum property in Dallas that we talked about, 419 units. And so then this is our North Carolina assets. John and Bobby is our local partners. Macon, same team that we did the Georgia one. Then this is our Denver market. It's interesting, we bought this one last year. This year, the same day we bought this one, we closed another one with the same team. And then this is the one we have in Dallas area. It's a Class A in a Fade downtown building. This is the crown jewel of the downtown. So we bought this. We bought 2 parcels of land here. We are building 2 of those here. And that is will come online to raise for this one as well. We bought the land already. Design is finished. We're going to the city for entitlement. Then we'll come back and finish that. So we'll have 3 buildings in Fade downtown. It's a really coolest place to go. This was our entry to the mixed-use arena. And that's the first asset where Massive came together. That's 2 property portfolio, 235 units. And here we are still playing together. So I'll stop sharing. That was a lot, by the way. I appreciate you guys listening in. So I'll open up for Q&A. And any question is welcome. Back to you, Vinky.
Yeah, thank you so much. I think that was so wonderful to see your growth trajectory, and it's pretty fast, within 1 year acquiring that many assets. And I love the flywheel approach that you guys have adopted day one. So you mentioned a few things in your presentation. The first thing you said was you matched the skill sets first, then the relationship came afterwards. So if you can shed some light on that, how did you match the skill set, or what exactly you were seeking that you found the right partners and you just took this tremendous upward turn?
Thank you. So our philosophy has been life needs to be back solved. It's not from solving. Like, there's two schools of thoughts. One is let's go take a first step, figure it out. Then you go back and incrementally improve as you go through. We all have been there, right? We all want, we want to work. Okay, let's go figure it out. Let's get better at it. Then let's get the next promotion. Let's get the next bump, whatever the case might be. But for us, it's back solving. It's not what's the next best thing. It's what does good look like. Let's start with that. So we said 5 years from now, we want a company and that has $500 million worth of assets. And I want a team. Today, they can handle a $500 million asset. That's how we started. That set the stage of what kind of qualities we're looking for. So we said, okay, if that's an organization, I need a CEO, CFO, and COO. So even though we didn't have anything, but we're talking about a team structure as we go. Okay.
No combination.
So, and that's how, give me a second. So on that, that's how we started. So I could have shared one of the old structure that we have. Sanjay came in as a COO. I came in as a CFO. Mike came in as a CIO, Chief Investment Officer, and we had no assets. We are laughing, take a look at us. We have nothing, but we have titles. So that told us that, okay, can the team today say I had run a $500 million organization and we have delivered that? And then what happens? And we saw right away we had a gap in terms of the finance, in terms of the accounting, in terms of the marketing. So we had that map and we went after the people to say, I need you, come and help us. I need you to come and help us. So we led 5 years outlook from the very beginning. That helped us, the skill set, that helped us the network.
So the follow-up question for you is, you all have a diverse background, not necessarily in real estate. So first question is, why real estate? And the second question is, how real estate, because how did you get here? I mean, it's amazing in 1 year.
It's my wife's fault. That's what I would say. And she knows it too. So a joke. Oh, no, it's a true story. So my wife, I think I married up at least 2 layers up at a minimum. So my retirement plan on her, when I met her, she was like high flyer, ExxonMobil, getting promotion, boom, boom, boom. I thought she's going to be a VP, get her own private jet, I'll retire, right? I'll be the guy going to different countries to retire. But then we got the first kid, job it's a job. Second kid, I still remember the day she came out, like in the middle of the night, I'm doing some work on the upstream side. She goes, Shariah, I think I'm going to quit. I was like, okay. So she decided to come home, and it's been 5 years. She decided to come home, and then we built a lifestyle with the 2 earnings. So I had to do something, and I'm a P&L guy. I looked at my P&L. The biggest line item in my P&L was tax. And I said, I'm going to go after the tax. Went to bigger pockets. Then I started the same single family space. But man, I had a tough time. I was working at the upstream with Sinead, negotiating with the Canadian governments, $100, $200 million to contract. I come home, my GC runs away with the 2x4. Somebody steals a bathroom sink. It's like it was too mess. Then someone said, go Shariah, buy 7. We did some calculation that if you have 7, you can have a property management company. I bought 7. Then still I'm stretching thin. Then someone says, buy more. And then I met somebody, he said, I'm retired. And I still remember I have 53 houses. I was like, oh, hell, I'm going to go to 53. So my first year I came to real estate, I bought 17 properties. It was 2017. And then, I was like, okay, I got the rhythm of it. And I also do angel investing. So I was like, okay, let me think about it as a business, not as an individual. So I called one of my friends who was the founder of neighborhoodranking.com. I was like, hey, man, how did you come up with the neighborhood ranking? Give me the definition. So I can use the definition and figure out what locations to go by. So he's a math PhD. He gave me whatever that, gave it to me. And he gave me 2 things that I took away. One, buy at the residential side, buying the location, which is the cheapest and closest to the most expensive one. And then buy and make sure that location has a hard barrier to entry. There's a freeway, there's a road, there's a crossover doesn't happen. So I took it and I went to Harris County and pulled out all the data and I came up with my model and I identified 2 areas to go to and I went and bought everything else out, whatever's available. So Independent Heights in Houston, I bought 34 properties year 2 and worked out well. Then I went to Acres Homes. I bought about, at some point, I owned more than 30% land there. So I used data model and marketing for the small company, and that's where we bought our residential. So I came into the real estate on the residential, but I saw how data and marketing put together, I can scale up really, really quick. Like up until Q1 this year, I was buying one property every 4 days. Just imagine the volume I was closing on, right? That's on the buy side. Then on the sell side. So we saw that. So in that sense, that gave me the confidence that scalability is there. There's an arbitrage, there's a market gap. So if you think about like a company, you can do it. Funding is available. You can do it. That's how I came in. Sanjay is the same thing. He came into real estate. He rotated about 9 multifamily full cycle. That's his skill set. He was a CEO for a reason, right? He did there. And I was the strategy guy and the finance, kind of sort of CEO role, because I get the strategy, I get the tactics, I get the play, I can build a team. And so couple that is nice. And Mike, the best person you want to hang out with. So here you go. He raises money for us on the retail side. So put together, we saw how we kind of came together. That's how it was.
Wow, interesting. And you said you were buying one property every 4 weeks. So
every 3 days, 3.5 days.
2.5 days. So how were you doing that? You have like really deeper pockets, or how you were getting the money? I mean, tell us that secret.
Awesome. So this is good. So, this is a cool story. I worked with McKinsey a lot. As you guys know, McKinsey Consulting. So last 8 years at Shell, I worked with McKinsey every 1 year, every year. So on the McKinsey side, we did a coded project for upstream, and it was an interesting project. So I was bored. I was like, fine, can I do the same strategy on me, what I want to do? So we did the strategy on me and also on real estate. Then I said, how do we match? The whole idea is that where is the gap that I can play and create an arbitrage? So what I saw, real estate runs on lending. That means if I want to compete, I need to compete where no lending is available, which is land. And the second thing is, if I don't have money to buy, then I can control my frequency of buying by reducing the amount that I spend per deal. If I do a cross section, inner city, less than $50,000 per unit was my play. And that's when we went after. So I called some of my friends, and we work in a corporate world. So I started with very less capital, but started with no debt, only land basis. And then selling was an issue. I had to sell at a higher frequency. I didn't know the MLS and HAR, all this kind of other stuff. So I called the wholesaler. I paid him $80,000. He gave me his investor database. So I had a selling pipeline bolt on in right there. So I partnered with the wholesalers to sell everything what I bought in the cash, and it was a high frequency transaction. So capital was stacked up. So up until now, on my residential side, I'm only 17% levered, 17% levered, and we have quite a bit there. So it's a tactical data-driven model. Yeah. Then I want to buy one, then a two, then a three.
Interesting. Wow, that's great. So another thing that you mentioned was that you got it from your local broker that buy cheap and sell at high, but buy in the locations which are more accessible. So tell us about that too, because you might have to hold the property for a long time, right? Sometimes if you're buying at the cheaper places, if the location is not, cheaper place is not that great location. I'm thinking about California right now. So it takes a long time to be gentrified or get to the level where you can say, okay, this is a class B neighborhood or class A neighborhood now, where I can get the, really cash in whatever my investment is.
Cool. Okay, so we're very simple in a sense. When we run a model, we don't go after the neighborhood that is gentrifying, buying so many properties all we can sell. What I see today, I'm going to see 3 years from now. It's not going to change. At least my buying asset is not going to change a whole lot. And then second thing is cheap is relative. There are two kinds of lower cost. One is benchmarking against a higher expensive neighborhood. Other one is adjusted for the local neighborhood. So from the California, anywhere in Houston is cheap, right? But it doesn't mean that adjusted for the local location is cheap enough. So when we price it, we have the 2 layers of adjustments. So if I go to Pasadena, I'm not going to pay today more than 65, 70 grand a unit. for a Class C asset. But if I go to Denver on a Class C, I'm more than happy to pay you $250,000 a unit. We would not have the understanding unless we have been there both sides. That's also because we don't go after the price. As of today, we did not go after the price at all. All the property that we bought, we went after the margin. It's the margin that's what drives the price. I don't care what the price is. I could buy at a 1 cap. But if I think I can create enough margin comfortably when I exit, if I cannot, it's not worthwhile even an 8 cap. So again, back solve. It's all about the exit. And then exit, step before the exit is my margin, and then that my price. So when we bought everything, we looked at that way. That, hey, I'm going to sell what I get today. We got to have a certain amount of margin, whatever the price shakes out to be. Not the price first, then pro forma, and then the exit. We don't look at that way. It's all about the back solve.
Wow, I love your leadership skills. And I can see, like, you can visualize, you can see things in your mind before you implement them. Because the way you're explaining it to me, that's the way I see you right now. So for an average person, who is just starting off or kind of midway through this, can you share with that person or with all of us actually, your strategies that you use to collaborate with others? Because you have collaborated with the builders too, because Massive comes down here, I saw in your chart. And then in the middle, your developers are sitting. So what are some of the strategies that you use to build these strong relationships for you? So that, in 1 year, oh my God, I can't even get behind it, that many units.
We have been blessed with relationship. And, what we say, if I have to check 10 things on a deal, 1 to 9 is all about we underwrite our partners, and underwriting deal is number 10. If that, we underwrite everybody first, then the deal, then anything else. So, and if I step back and say, what if I would go back and redo it again, what I saw is that we got to be in the thick of everything. I can watch the game and I can comment on how to win the game all day long, but help, if I don't play on top of the game and other people looking at me, is tough. So anybody who wants to invest, start playing the game and know that you're going to make mistakes. We did. Everybody will do it. You'll have a fair share of it. But the idea is that since you're going to play so many games and you should go after those 1s and 2s, forget the home run. I cannot say so many, and how strongly I feel about it is that go for the 1s and 2s. If you get comfortable with the 1s and 2s, when the home run shows up, you know how to hit it. But if you don't know how to hit 1s and 2s, you cannot hit a home run because you don't even know what the definition of home run is. So example, I'll go back to real estate on this residential side. We go after the margin 10 to 15 grand per transaction. Statistically, every 5 or so, there's one shows up 30 to 40. Every 10 or so, there shows up 100. But if you do 40, even though I'm after the 10 to 15 grand margin where people say, nah, that's too little, I average out 30 to 40 grand a transaction, right? So investment the same way. If I'm an LP, get started. If you don't want to spend the first 50 grand, 75 grand, we get it. Call up some of the people you like and say, hey, I need a favor. Can you let me in a smaller ticket? It's all about the relationship, right? The first thing I would say, get started, get going. The more you're going to wait, the more you're going to lose out. I am yet to see anybody in the real estate who said, I wish I would have waited. Right? And the second thing is that know your play, laid out for 4 or 5 years, a game plan. Start with whatever you have. And if it's below, above somebody, just call up who you like and negotiate a price and come in. But unless you be in the game, you don't know how the game is being played. Outside, it's different. Inside, it's different. That's all.
That's true. Just knowing the holistic picture. And I love the way you put it, is being strategic and having the clarity of your goals. So a lot of times, if the goal is not clear, you're kind of lost in the game, like you're using the terminology game. So I'm going to say the same thing, game. You're lost in the game because there's no clarity. So if you're starting small and if you know exactly what your target is, you're going to achieve it sooner or later, and have some patience there. And then I'm going to ask you one question here is you mentioned a couple of times the word negotiation, and negotiation is very, very important in the real estate. So I would like to ask you a question, what has worked for you, or what kind of skill set you need to be a good negotiator, because you're negotiating even with your partners, with the brokers, with the lenders. It's kind of day-to-day skill set that you need.
Within our partners, the couple of taglines that we use. Number one, you need to be you. I need to be me. That means that whoever we are, we need to be that, and other parties should be able to accept it. If it is not, we'll come back some other time, right? So within our team, we're extremely comfortable about who we are. If we don't like it, we just say it the way it is. We want you to say exactly the same way, so we can talk about uncomfortable conversation. Mm-hmm. So that really worked out within our team. I mean, Trevor can attest to it. We talk from our heart explicitly, and there's no holdback, right? Because issue happens when I started make assumptions, when someone starts making assumptions, right? So that's one. Outside the team, when we look at it, we're a hard believer of that. We need to be able to add value. Mm-hmm. That means we need to have something I am bringing in others don't have. There must be a leverage that we kind of come in a commercial negotiating, right? And that starts with the team. That should start with the balance sheet and liquidity. So inside the team, it's all about open-hearted conversation based on the skill set. That, if someone doesn't like what I'm doing and I'm behind, I'm not delivering, you should be able to say, hey, Shariah, man, one time it was okay. Second time, I'm not happy. Third time, you better come through, right? Same thing, I should be able to say that very comfortably. That's an outside the team. It's a very tactical play. When you go to the bank, we don't ask for a loan. We go to the bank to interview the bank, whether they will like a customer like us. It's a weird philosophy, but it worked out for us all the time. And when I go to any other broker, we said, we qualify, we underwrite the brokers, we underwrite debt brokers, underwrite banks, underwrite every broker. Because, everybody has a pulse. We want to know who they are, what they think, what the investing strategy is, what the lending capacity is, what do they do once they get the loan, where they get the money from. So we make sure when we bring a deal, it's going to hit it, and they're not going to run away. Also, they know that we're going to show up not once a year. We're going to show up 3, 4, 5 times a year. So we try to be a lot more programmatic partnership. So on all of our investors or investment GP partners, our thing is that we need to be able to see us doing a deal number 3, 4, and 5. Mm-hmm. If we don't see deal number 3, 4, and 5, we should not do deal number 1 and 2. And it worked out. We lost a lot of deals, fine. We lost a lot of money, but man, we stuck around with the friends that we have, and we got some good set of friends. Same with the lenders. We said, look, I'm not one of those teams that we're going to show up once a year. It's a close, but we are going to show up to you all the time. You're going to make money. Let's talk about the points and the fees and your structure right away. And so that's what we've done. So we have about 6 lenders that we kept extremely tight with. Whole idea is that if a GP team goes there once a year, the margin, the cost they're going to have, we must have a lower cost because I'm coming to you 3 times a year. Mm-hmm. Otherwise, there's no benefit. So Arbor, we have a good Walker Dunlop, then PGIM, about 4 credit unions here. We have good relationships. And then to a point, we still get 70%, 75% LTC on our loans that we're looking at today on a sub $7 million deals. On anything above the $7 million, if the team gets a 1.35 DSCR, we got a 1.3. If the team gets 1.3, we got a 1.25. So you have some leverage based on the team than anything else. Yeah, we negotiate everything and we underwrite everything and everybody.
Mm-hmm. Interesting. I love that strategy. And then lost deals are like the experience, actually. You gain from every lost deal. Everything didn't work out. Lesson learned for the next time, like how you can make yourself better. So here I'm going to ask you, talk about your challenges with us too. What kind of challenges that you have seen and how did you overcome with your experience?
There's a lot of questions. Okay, I'll start with my family. Without my wife, I was nobody because she keeps the house so in a good place. It's like if she would not be there, it would have been a nightmare. It's still a nightmare. I work a lot. But if she would not be the most reliable person I could go on, that's what. So before we get into that, I had to get alignment on it. Hey, I'm going to go do outside. Could you help me? If I'm not home 15, 16 hours a day, would you back me up? That alignment was needed. we have to calibrate as we go through because whatever we do under Massive, she's directly impacted and my kids are directly impacted because of my time, right? So that was my number 1, 2, and 3. It was a huge learning for us last 2 years. My kids went through the whole thing. So that's that. And that's my biggest learning, right? That's a struggle. That was a struggle, still a struggle. But without my wife, I would not be able to spend the time without any kind of overhang bugging me up until that. So that was that. And the second thing is the financial play. We like investing, but as you know, everything happens when we sell, right? So 3 years of journey till you sell, it's a big undertaking coming from the corporate world. I went from 2 earning to 1 earning to 0 earning, right? So that planning had to take place. And then those 2 was my biggest learning. And within the Massive side, it's sticking around with the philosophy and the strategy, not going after that 1 or 2 short, really profitable projects early on, right? That's the difference. That the last one especially, it's tough when you see everybody's doing deals, the number makes sense, but then it's different than how we have designed. And especially when say tap into Shuraya, I want only you, not Massive. Or Mike, we want only you, not Shuraya and Sanjay. Those staying with the principle is tough. And that has been a huge journey for us. That staying with the principle, staying as a team, not let the side one come in, make you happy, but kills you the long term. That has been a big one for us as well.
That's really good. I think when you have that kind of strategy, it helps you as a whole because your whole time is not taken or your whole mind is not taken away, because you have some space in your mind to think about something more innovative, something more creative ways of doing things. And I think that's the reason your strategies are working because you have created a space for yourself, getting the help from your family or getting the help with your teammates. And that's very, very important because a lot of times people think I'm going to do everything myself. That does not work because we do not have enough hours in the day to do everything ourselves, So, but thank you so much. But I'm going to open it up to everybody. I think I ran out of questions. He answered all my questions. So if you have any questions, please raise your hand and or just unmute yourself and ask. I'm pretty sure a lot of people have a lot of questions. Nobody has any question. I think you answered all the questions, Shahryar.
I confused everybody. I'm good at it. So sorry. Questions gonna come afterwards. That's not a problem.
Devin has a question. Devin, go ahead.
Hi there. So I was wondering, what are some recommended first steps a collegiate graduate can take and or a current master's could take in the commercial real estate world to learn on top of their studies while gaining income?
So you are still in the college, right? About to finish, is that right?
Graduate school. I have just started, yes.
Oh, that's awesome. Okay, cool. So association bias, that's what I would start with. Start hanging out with the team, with the people who have walked the path you were thinking to walk for a long time and they're successful. And that association bias, be very keen about it. And on that note, narrow down your association because everybody in the world, they are investing in real estate, but not everybody in the world, they are gonna be there where you are trying to be there, right? So I would say association bias will be the big deal and it's gonna hurt, but find some education platform and you go sign up and you go pay to kind of get you a very tighter bandwidth of the people that you're gonna learn from and hang out from. And what's going to happen is you are working on a frequency and everybody walks on the same frequency. When you hit them both together, you will amplify. And that amplification has to happen very, very quick if you really want to get started. So I would say first thing, or the only thing for now will be association bias and pick the niche set of people that you want to hang out so you can amplify your journey as you kind of go. Best way to go for would be find an education platform, pay the fee and get in. Full disclaimer, I was in a school of thought, I could have done it all, but hell, I was dead wrong. So I'm Massive at the team. We sit into every single platform you can sit into. But that paid us extreme amount of dividend as you kind of go. So even though I started on your shoes, I'm on these shoes now. Go find the education platform, go sign up, so you can really hang out with the people that you need to hang out with. Some of them will be at your phase, thinking to get started, but some of them will be all the other side, been there for decades. But you'll get them into those groups, which you cannot get them outside. If you spend an hour on Facebook, hypothetically, or Bigger Pockets, you'll find a whole bunch of noise and one or two. But if you go to those education platforms, you'll find a very tight band of people that are exactly living, breathing, thinking what you're thinking.
And are there any recommended educational platforms?
To me, no. It depends on you and your style, right? I'll give you an example, right? I sit in Brad Samrock, we sit in Massive as a team, Brad Samrock, Rod Khalif, 10X, Jake and Gino, Think Multifamily, Total Wealth. And it starts from you, depending on how you want to play. Brad, then, it's kind of funny. So we rank everybody. We said, what is the core mass population wants to do in a certain category, right? To me, Brad's team are the PhDs of the world. They have done good deals. They do great deals. They do expensive deals. And, 10X is the freshman of the world. They haven't done anything yet, but those freshmen will be killers. They all come from the business side. They're going to be sophomore and junior really, really quick. Rod Khalif will be right around sophomore, senior. Jake and Gino is sophomore getting out to juniors. So depending on who you want to play. And if I say I am going to go hang out with the PhDs and I'm okay to get killed, fine, come on over. They'll put you in a very high expectation. If you say I want to get started, I want to try a little bit more, Jake and Gino, Rod Khalif, you're not going to go wrong. And if you own a business already and you're making money, you want to work with some of the other business owners, go to 10X. For us, we understood everybody has a different culture, so we signed up for all.
Gotcha. Yeah, I totally agree with the Brad Samrock. I'll be going to the AIMNICON this month.
Awesome. So. Yeah, it's a great set. I have mad respect for his team. And one of my good friends, First Asset, again, she comes from a corporate background. That's where you're going to get more off because they have money and they have balance sheets. So if you don't have those two in that team, you will have to work double, triple the amount to get a deal. But if you can make it, you'll be in a better spot. So know your play. Our first deal was a $30 million deal. First deal. But they come from corporate world. They have run large organizations. They're used to it. She has a fair share of learning, but that's what the Brad's team will do if you get to the right spot. Good question, Dylan.
Thank you.
Yeah, that was good advice. I really like that, Sharia. And then you're right. There's so many houses out there, everybody's teaching kind of different way, same thing, but a little bit different way. And a lot of noise out there too. So maybe I can ask the follow-up question to you, how to cut the noise? Because sometimes people get caught up with all the noise around them because it's like all the shiny objects. Let me do this, let me do this, let me do that, and never get anywhere,
If the drive doesn't come from internally, it's tough, right? It is tough. I've seen people cutting $100,000 check, then okay with it, move on. They don't do anything. On the other side, we have had where, we counted every single penny went out the door and we went for it.
Mm-hmm.
And so that's that. So noise will be there. I also believe that there is always, you have a kernel of truth into all this stuff. So all the platforms, they're good for somebody as long as you can make it work. So to me, it's like going to school. Like I went to Prairie View from my undergrad. I went to Rice from my grad. You can go to U of H. You can go Chicago, Booth. You can go Harvard. It's only what you make out of it. End of the day, same textbook, a different version of it, Venki, right? So that's what I would lean towards. There's no bad or good to me as long as I am going in with the very clear intention of making something out of it. And everybody who went in, they were successful.
Mm-hmm. I agree on that. Anybody has any more questions? If you have any question, unmute yourself or raise your hand, and this is your time to ask Shahryar his wealth of knowledge. And I really like you say it comes within, because if you're not ready, the success does not come to you. And I have seen that in my life, and I have seen that, I have experienced that too. Because if you just keep on sitting on the sidelines and do not create that thought within you or the desire within you, and so strong desire that I have to make this happen, until then, nothing happens. Any more questions for Shahryar? Just wanted to remind everybody to unmute yourself if you have a question. Sorry, Shahryar, didn't mean to speak over you.
I was going to say, one of my mentor early on, he was like, if you go into real estate, you do deal number one, If that's successful, it gets accelerated. If it's failure, then most of the people go down to zero. But the true way of thinking about it is that you make a mistake one, fine, go buy 10 more. You will cost average out, you'll win the money on the deal number 3 and 4, right? That we forget sometimes. Mistakes will happen, right? We'll fall down. But do so many deals, you're gonna come out on the other side of it. That kind of stuck with me for so long. So mistakes will happen, and we will get the side jabs here and there, but keep working at it. Keep working at it. And the second thing, what I would say, this is at Shell, we are very clear that people who want to go up, that time is the only thing you have on your side. Everybody's smarter than you. Everybody out-networks you. Time is the only thing you have on your side. So you got to outwork everybody. 2,000 work hours a year. If someone does 3,000 in 2 years, you have done 3 years worth of work. So you're already ahead of 1 year's worth of knowledge. Don't forget, that is powerful. None of our team are sitting down. We have 14, 15 of us. We are grinding. That's what it is. Massive is built on 15 different shoulders, and everybody is firing all the cylinders all the time.
Yeah, I agree on that. Sometimes when you fail one time, some people, they go back into their shell. But some people, they just like, oh God, how did that happen? They just go even double the force. So here I have another question for you from Ram. How challenging to do first syndication in this market? Mindset question.
It was tough. I struggled like there's no tomorrow. So I'll be open up. Most of my transaction, I keep my residential transaction less than 150 grand per deal. That's the top end. But in general, my critical mass is about $70,000. That's also because we do all cash deals, right? So it's heavy, high volume. So for me, when I came into the multifamily, underwriting a $5 million deal was a struggle. I bought a bunch of warehouses in between, but each of the warehouse about $1.5 million, right? So I never touched more than $2 million. So underwriting a $5 million was a mind boggle for me. But then I met those geniuses, Sanjay and Mike. I still remember we went for lunch, walking the property. First property that we walked together, that's a $19 million property. And I was like, I don't know what to do, but I will just hang out with Sanjay and Mike, another friend, Ajit. We went for a lunch. We sat down for 30 minutes, and they were comfortable like there's no tomorrow, and they came up with the price, $19 million. All I knew, I don't know what they did, but I know they were comfortable and they know how they're going to take the deal down. I'm game, right? So this is so cool. The association bias matters. So it was challenging for me. It was a struggle for me, but I had a leap of faith. I said, I'm going to plunge and I'm going to bet on somebody else's knowledge, and I'll see how I can add value later. So that was a big learning curve for me. I went from a 3 to a 20, just like that. I would not be able to get there unless my friends would have been there.
So if we do not have any more questions, we have a little bit time, we can network, and then we can do a small breakout rooms. So Shahryar, would you please share your contact information with everybody, how people can reach out to you?